Up next, let's talk about the latest activity when it comes to the grain market. Darin Newsom, senior BarChart Analyst, is joining us today. Hey, Darin, thank you very much for the time.
Yeah, appreciate you having me on again, Bryce.
Hope you're having a good spring as we take a look at these markets. We begin in the corn market. And on Wednesday, you kind of summarized things saying the corn market might as well have been closed all day. That's kind of a blunt way to put things.
Yeah, it's going nowhere fast. I mean, there's a phrase I like out there. It's been used by a number of folks over the years, sharply sideways, and that just seems to be what corn's comfortable doing right now. It doesn't have any reason to go up, doesn't have any reason to go down. As far as the old crop market goes, we've seen basis firm a little bit, but I mean, we still have ample supplies to meet demand. We just have merchandisers pushing the cash market a bit, knowing producers are going to get pretty busy out in the field, so they're not going to be delivering as much to town. So, I mean, most of the activity has been in the basis market. Futures just more than happy to go sideways right now.
Well, regular viewers know that we'd like to solicit questions here on the program. We had several of them come in. One on the soybean front, Darin. Somebody just asked, what's going on in the soybean market? Take a look at the chart, and it's kind of in that sideways trend, but generally trending lower. Your thoughts on soybeans?
Yeah, it was interesting. I posted a chart of the day on it Tuesday afternoon. And when I started writing my piece, I was talking about how the old crop market was still in an uptrend. But then as I took a closer look at the chart, I think you could actually make the argument that the market is still in a downtrend. And this fits with what we see in the National Soybean Index, which is the national average cash price. If we go back a year ago, it completed a technical pattern on its monthly close only chart, meaning its long-term downside target was 10 and a quarter. At Tuesday evening, the index was priced at $10.90. So, we've still got some room to go down in the cash market, and if that's the case, I think it bolsters the argument that old crop soybeans still look like they've got some room to go down.
I've got a question to ask you on the wheat front, but first, let's get your general thoughts on the wheat complex.
Wheat is all over the place right now. And I think as we look at what's been going on in the winter markets, particularly in the new crop future spreads, we're seeing the commercial side getting more bearish. And so the bottom line is they're growing more comfortable with 2024 production. Both hard red winter and soft red winter certainly ties into some of the rain events that have moved through, some more that are expected this upcoming weekend and early next week. So, we'll see how all that plays out. But right now, as we look, again, at the Kansas City and Chicago spreads, they're both covering bearish levels of calculated full commercial carry, and it just isn't going to allow these markets to move very much, to rally much. And anytime they do see attempted rallies, some buying interest come in, they're going to be met with pretty heavy selling.
Scott wrote in this week on the wheat front, looking at kind of the historical context, the last 10, 15 years of the wheat market here domestically. And he's curious your thoughts on where you see the U.S. as a wheat producer 10 to 15 years from now. Kind of a big picture question, Darin.
It is a big picture question, and if I go back 10, 15 years from previously, the idea was wheat was going to lose a lot of ground to corn. Everything was going to go into corn because that was about at the boom of the corn market. I guess that was almost 20 years ago now, but the ethanol demand. So if we go 10 years in the future, I think wheat's still going to be hanging on. I still don't think the U.S. is going to be planting as many acres. I think we're going to continue to see that decline. And the biggest thing is, then it's going to come down to where is their water? Is there going to be water to continue to support more corn and more soybeans? Are we going to see, if there's not enough for that, there's not going to be enough water for cotton. So, that's going to be the one saving grace for the possibility of more wheat acres. But the problem is, the world just doesn't seem to want U.S. wheat supplies at this point, unless there's some sort of critical shortage around the world. They're just not interested in buying from the U.S.
Yeah, it's an interesting market to follow. Anything on the livestock front when it comes to hogs or cattle that's piqued your interest over the past week?
Yeah, I think what's really jumping out to me here is that there's a lot of inconsistencies on the commercial side, particularly in the live cattle. One day we see the commercials buying, we see the future spreads moving with nearby contracts gaining on deferreds, but they just can't keep it going consistently. And so, by the time we get to the next day or the close of the next day, that support has evaporated and been replaced with some pressure. So all of this kind of lends itself to the idea that the market has probably topped up here, and that the longer term trends are down. and we'll probably see these markets continue to go lower. I say probably because when it comes to cattle, sometimes you have to hedge your bets a bit. Fundamentally, they haven't changed all that much. There's still talk that, we've got tighter supplies. We still have good demand. We can see that in the box beef markets. But just from just the market overall just seems a bit top heavy up here. Seems like it has an easier time going down than up.
Darin, you're up in Omaha. I'm broadcasting from Lincoln. Feel the need to mention that because about a week or so ago, I guess probably more at this point, I could hear the groans and the sadness coming from your house as USDA came out with an announcement. The survey division saying they're going to stop several reports. Say that very sarcastically. I think all of our viewers know how you feel about USDA reports, but in particular, seems like the folks in the cattle side of things were particularly disappointed about the July inventory report being discontinued. Tell us, why does that not matter?
Simply, all we have to do is look at the markets. I mean, let's look at what the June, August, October, December spreads are telling us. We can read everything we need to know about inventory there. If we combine that with what we can read in the feeder cattle spreads as well, in the feeder cattle markets. I mean, all of the information is in front of us. What we won't have is the made up numbers, because we all know those numbers aren't real. They just come up. Economists just come up with them from somewhere. So the numbers aren't real. But if we want to understand real supply and demand, real fundamentals, it's all right in front of us in the markets. We can look at basis. We can look at spreads. We can see how money flow is coming into or out of the market. And that's all we need to know. I mean, understanding imaginary numbers really doesn't do anybody any good. And so, all the hand wringing and rending of garments over the fact that USDA is going to drop some of these meaningless reports, I just don't get it. I just don't think they're that important to begin with.
Understand your perspective. That's why we have you on here, Darin, to get that. Few seconds left here. Let's just get your final thoughts as we sit here. Planting really going to be ramping up over the next week or two. Your final thoughts.
Yeah, I think it's going to be interesting to watch the weather here. Obviously, here in mid-April, we are just now turning the corner into, these markets are weather derivatives. So certainly, I mean, almost every conversation from here on out through the summer is going to start and end with weather.